ETFs, or exchange traded funds, are one of the easiest ways to invest into the stock market. But how do you actually research an ETF before investing? Like, how do you do your due diligence so that you know whether the ETFs that you're looking at are worth to invest into? So in this video, I'll walk you through everything you need to check before buying an ETF so that you can make an informed and smart investment decision. So let's jump right into it. We're gonna also do a bit of a tour in terms of like going through a website to show you all the different considerations you need to go through. But basically, what makes a good ETF? What are characteristics you should consider? Firstly, it should have strong past performance. So it should have consistent long-term growth. It doesn't make sense to buy into something just because it sounds cool if the performance so far has been abysmal. It should be consistently strong, and it should therefore, have certain characteristics like a historical growth trajectory to show that it's been growing over time. Because otherwise, I mean, the past doesn't predict the future, but it's an indication of where and how the ETF has been going and the companies in it, and therefore whether it's worth for you to invest into. It should have low fees. Less than 0.2% is ideal because, as we've explained in another video, the ETFs come at a fee tier. They have a fund management fee, something that the company charges that manages the fund to as a management fee. And so, the lower fees, the better, because these fees stack up over time. So you want to make sure that you're paying the least amount possible. They should be diversified. They should be global, versus regional and the sector-specific ETFs. But it's good to have a diversification across, as we've discussed in the other video, where we discussed ETFs, and the timeless investing tips that you should be diversified across regions, across sectors, across asset classes, ideally. And so these are things to consider. It should be a physical replication. So when you buy the fund, you own the underlying stock. That's what physical replication means. It means when you buy this fund, remember how an ETF tracks thousands of companies or even hundreds or even thousands of companies when you say you track an index, like the 500 largest companies in the United States. There's an ETF that tracks this index. The S&P 500 it's called. And you can buy a synthetic replication of it, where basically you track the price of it, and then you tie it to this company that basically tracks this price. And if the company goes bankrupt, then I don't know, maybe there might be some risk involved. But when you have the physical replication, that means that you own the underlying stock, which means you have an extra layer of security. If, say, the financial company goes bankrupt, then you still own the underlying stock. You still own it. So even if the company is bankrupt, you still have the value of the stock of the companies that you invested into. So if you say invest into the S&P 500, you still own a proportion of the S&P 500 of all the stocks in there, like Tesla, Google, Microsoft, all of these companies. So that means you have more of a security in that way. So there's a large fund volume is good, because that fund signals that the fund will continue to exist, because there's a lot of funds out there. There's thousands of funds. There's new funds that are added every single day. And some of them never anyone will actually invest into because it's too, not every single fund people will invest into because there's just so many. And so some of these funds might close over time. Most often when this happens, like, you will just get your money paid out to you. But obviously, you don't want to constantly reshuffle your money. You want to have your money in a fund and just let that be, and then just let it sit there forever. For a long time, so that you can then at some point, maybe retire of that. And if you constantly buy a new fund that just came out, and that fund then goes bankrupt, then you just get your money paid out again. Then you're not really having your money work for you, but you keep having to reshuffle it, which is annoying. So the larger the fund volume, the better. It just signals that it's a stable, continuing fund. You want an old ETF age. So you want to be able to see the historic growth performance of an ETF, because that will allow you to see how the growth has been going, to make sure that, as we said before, the strong past performance, whether there's been consistent growth, and therefore whether it's worth to invest. A great place to find ETF data is Just ETF. It's a very comprehensive website that allows you to compare ETFs and to see the historic growth of ETFs and compare the historic growth of ETFs. And we'll show you that in just a moment. And then also recommend looking at the individual websites of the ETF that you want to buy to further understand the sustainability criteria, for example, the historic growth and the statistics behind it, because maybe they are slightly more accurate. Yeah, it's just good to have a look to in detail look at the information there as well. But Just ETF will provide you all of that in a very detailed way. But maybe there are some things that you can have a look at on the actual website of the ETF. Like, for example, the dividend yield is one of those things. Remember the amount of money that a company, or in this case a fund like an ETF, pays out to its shareholders, which is money that companies pay out to their shareholders as a reward for them holding that share, So that's, for example, one thing that you might have to check on the websites, because on Just ETF I haven't found it yet. But yes, so maybe we'll just jump into a demonstration of Just ETF to show you the value of this platform. We're going to show you briefly here and then go through the metrics that we just talked about in a little bit more detail to show you, what exactly to look out for. And then we will do some research together through this platform after that to show you exactly what you can look at within this research platform that we showed you to correctly see whether a ETF is worth buying or not worth buying. Obviously, it's your choice. And we're just giving you the tools that you need to be able to do your own research. And obviously there's other factors to consider. This might not be everything to look at, but these are, I guess, some of the most important ones to look at when you are doing your due diligence. The site where you can compare your ETFs and see things like, let's actually go back. You can see things like, the past year percentage growth. So this one, for example, Bitcoin has been going up by 300% in the past year. Now that's quite a risky one, but just to show you, you can see the growth, you can see the distribution, whether it's accumulating or distributing. It's another important thing to consider. We'll go into that in just a moment. You want to see if it's physically backed and your percentage fee tier, the fund size, and all of these things you can see. These are some key metrics to look at. When you do your research, you look at the fund's past history. You want to see past returns versus the index. You want to see, whether the performance has been strong in the past. All of these things are also contained in the ETF checklist. But, as we said before, the past performance may not be a predictor of the future, but it may be an indicator of where the growth and how the growth is happening. And if a fund has a poor performance, let's say, maybe your friend told you something about, this ETF is amazing, like, do your research, look at it. Don't just buy it. First of all, don't just buy an ETF. If I tell you, if your friend tells you, it doesn't matter. Do your own due diligence, you want to look at the past performance. And if the past performance is shit, then it probably doesn't even make sense to look at any of the other things we've listed here. This is the first thing. Look at the performance. If the performance is shit, move on. Because there's no point in investing into something over the next 10 years if you think, it's going to go through the roof and like I've seen this article, whatever, I would probably just leave your fingers away from a passive investment opportunity if the past performance has been poor. Then, if the past performance has been good, look at the expense ratio. Is it low expense? How does the price follow the index? Is there an error? Sometimes, if the index has a certain price and the price of the investment doesn't follow it, then there might be an issue. So I would have a look at that. Check the diversification, look at dividends, is there income potential? This is something that we'll also discuss later. What is a dividend ETF? We haven't discussed yet, but basically, to cut it short, a dividend is when a company pays its investors some of its profits in form of cold hard cash that you literally get paid into your brokerage account, which is often like, 2%, 3%, 4%, sometimes even 5% if you're lucky. But yeah, then what are the top holdings in the ETF? Make sure that when you buy multiple ETFs, that you don't have too big of an overlap. This is a key one, okay? Because sometimes you think, oh, I'm going to buy this ETF that tracks the best companies in the world, and now I'm going to buy this ETF that tracks the best European companies. There might be some overlap there, and you should be aware of that. If a big proportion of them are the same companies, often, the largest holdings can be often Microsoft, Apple, and Google. Let's say you buy one ETF that's the largest companies in the world, and then one sustainable ETF or something that's the largest in the world, but like, excluding fossil fuels. The largest holdings might still be Google, Amazon, Microsoft, these companies, and therefore you might be buying the exact same thing, which, if we look at diversification, is not good. So make sure to look at the best holdings to prevent you from having a fund overlap and therefore not being diversified. Very important. Physical replication. When you buy the fund, you own the underlying stock, as we've discussed before. And we'll show you in a moment how to see all of this as well. And then large fund volume, looking that the fund it has a lot of investors, a lot of money is in that fund. That means it will probably continue to exist. You want to have a look at the fund age to see the historical growth trajectory. As we've discussed before, obviously if the performance in the past hasn't been good, there's no need to look further. This is the first thing you look at, as we have talked about before, because you can look at all these things, but if the thing just doesn't give good returns, then there's no reason to look any further. And so the fund age is also important because it signals fund continuity, similar to the fund size. So the fund volume, which is the amount of money that's in the fund, as we've said before, as a reminder, that also signals fund continuity. The fund age similarly does that. Another key thing to consider when choosing to buy an ETF is its distribution policy. Now, there's two types of distribution policies. It can be either accumulating or distributing. The key difference being that it is about the way dividends from the ETFs are being paid out to you as the shareholder. Now, let me explain. So, reflecting on dividends. Dividends are profits that are paid out to shareholders by the companies that give out the shares. So if you have an ETF and you have an Apple share in there somewhere, and then that Apple share gives dividends out to its shareholder, then you will get an accumulation of all of these dividends that companies are paying out from your ETF that holds hundreds of companies into your bank account. Now, this is under a distributing policy. You would then just get the cash paid into your bank account because it's distributing. That means all the profits that the share, all the dividends that are being paid out by these companies, they will just get paid into your brokerage account. But when you are accumulating, you would instead have these dividends automatically reinvested into that same ETF. So, instead of having it paid into your brokerage account, you would have it reinvested into your ETF, which, is good for compound interest because, instead of having these profits paid into your bank account, you would have it reinvested, which, if you look back at an earlier video, the Why Invest video, you will see that compound interest is a very strong force. It's very, very powerful to have your investments compound over long time horizons. So that's why getting accumulating policy, if you're looking to invest for a very, very long time, might be a wise choice. It's the choice that I go with, but honestly, make up your own mind. This is just to let you know what these policies even mean. And then, is it sustainable? Are there criteria that you care about? Like, does the fund exclude industries that you don't morally align with, or does it, focus on a theme that passes the energy transition? Check the ETF checklist that we have in this course as well. So just to show you how that looks like, we maybe going to split the screen so that we can do some research and look at this stuff here. So can I zoom into this maybe a little bit? Okay, cool. So let's jump into it. We have, say, ETF number one. Okay, in this course, we're going to talk about the iShares MSCI World ETF and how it could be a good part of your portfolio because it is a pretty good ETF. Spoiler alert, it's pretty good. But let's do our due diligence. Let's not just believe it just because, someone said it. Okay. So historical performance. Let's have a look. We check this chart and we look at, what's the historical growth like? Over 3 years, 31%. Over 5 years, 139%. Pretty good. Pretty good performance. Is it, we look at the fund age, right? So this thing has been existing for a while. If we scroll down here, we can see that the inception is on the 25th of September 2009. So this thing has been in existence for a while, which is a good sign. That's very good. It's been existing for over 15 years, which means, it's been there for a while. And the historical growth has been really strong throughout. If we check max, it's pretty good, 500%. Generally, I think fund age, like over 5 years is good. Anything, but obviously the more the merrier. So expense ratio. Let's have a look at the expense ratio. It is 0.2%. 0.2% is the total expense ratio for the fund management fee. Very low, very good. Good sign. Then the distribution policy. So I personally, in my stage at the moment, like accumulating more because it's less work for me. It just automatically reinvests. It's good. It's going to grow in value over time. In the long run, I'm going to make money. I'm going to be happy. But maybe for you, you want to have some money on the side and earn some income on the side. And then distributing might be better. So that's about the distribution policy. Then the diversification. Let's have a look. So if we go down here, we can see the country diversity. So this is the MSCI World ETF, but now we see, oh my God, the World ETF is actually 71% or 70.5% United States based. Cool, good to know for my diversification strategy. It seems to be country-wise not very diversified. It seems to be pretty diversified across sectors, which is good. It's one asset class, so this is stocks. So it's just that. And country diversity, not super diverse. But it's got, 5% Japan, 3% UK. But yeah, important to keep in mind, okay? And then dividend yield. I don't think you can actually see that here. But I mean, yeah, it's accumulating, so all of that will be automatically reinvested. Also not super important. It's a small percentage, but I mean, yeah, if you wanted to look for dividends, obviously you would look for more dividend-specific ETFs. This is more of a growth ETF, so the dividend wouldn't be super high. Focusing on companies that don't really pay out a lot of their profit to shareholders, being Apple, Nvidia, Microsoft, Amazon, and they rather invested into growth for the company, which is, good for you because so does your share price, so does your wealth. And looking at the top 10 holdings, so, these are big tech companies to the large extent. Tesla as well, Alphabet, Broadcom, JP Morgan. So, a bit of financials, bit of mostly tech, which is, they've been doing really well. This ETF, as we've seen, very strong growth. So overall, pretty strong. Fund volume. 87 billion euros, which is super large. And this is definitely, a good sign because the larger the fund size, the better, which means that you have more safety that this fund will continue to exist. I don't think this fund will cease to exist anytime in the next 10, 20, 30 years because it's so big and people invest into it and everyone makes money, everyone's happy. Then another one is holdings. I noticed actually we didn't mention that here either, so I'm mentioning it now. The top 10 top holdings, not just the top holdings, top and top holdings and number of holdings. Because the more holdings, the more diversified it is. It has 1,396 companies in it. That's a lot of companies, a lot of different stocks in it, which is really good. So it is super diverse. With other words, what type of replication is it? Where can you find this? This is really important. We talked about before. Here, replication, physically optimized sampling. This is a physical replication that is a good sign. Green light. ETF age, 2009, we've already covered it, distribution policy, and that's it. At the end of the day, this seems to be a really strong candidate. It depends on what your risk profile is, but because it has marked so many good points, with its strong historical growth being a very key factor here. Obviously, you want to maximize your money, so that's good. It's very large. It's got a lot of ETFs. It's physical. It's accumulating. It's got a low fee tier. It's been in existence for a while. It's got physical replication. It is a very, very strong ETF. Now, let's compare to one where, it might sound very cool, but if we look a little bit further, we notice that, maybe it's not ideal for us if we're looking for passive income over time. So let's have a look. Here, the Global Clean Energy ETF, sounds pretty good, right? Global clean energy, we're in the energy transition. Renewable energy is expanding around the world. We've got the Paris Agreement that says everyone has to reduce their emissions. There's global recognition that we should reduce our emissions. It's a sustainable ETF. We're investing into energy companies, that do renewable energy a lot. And so, surely that's a good investment, right? But let's have a look. Number one, historical growth performance. Okay, so this is 1 day. Now, if we go to 1 year, minus 17.66%. Not so good. And, minus 50% over 3 years. 5 years, no data, because this thing has been in existence since March 2021. So it seems like this thing has been just going downhill since it has been started, which means, the money would be not working for you, but actually working against you because you would be putting your money into an ETF that would decrease in money over time. So maybe not the best option. So if we look at the expense ratio, 0.6 per annum, not so cheap because it's tracking a theme. It's a thematic ETF, tracking global clean energy, and the Wilder New Energy Global Innovation Index, which might need some more active managing. So quite expensive. It is, how diverse is it? Quite diverse though. It's very diversified. Like you've got US, you've got Taiwan, you've got South Korea, China. But it doesn't matter because this thing has been performing so badly. So, I mean, technically, you should just stop researching once you see that. Like, once you see that, it's just done. It's like, okay, well, I'm not investing into it because over the past 3 years, this thing has been going absolutely down into the toilet. And so, why would I even consider it? You wouldn't. But we're just doing it just to show you. So, it's quite diverse. It's mostly focused on industrials, United States, China, South Korea, Taiwan, Japan, Canada, all these different ones. So, quite diverse at least. Dividend yield doesn't really say here, but something that you can Google for sure. Number of holdings and type top 10 holdings. So number of holdings, 110. It's good. It's okay. It's not crazy. Like I think for passive investing, having a lot of holdings like 500 plus is good because it's just something that you really don't have to pay any attention to ever, because if you have 500 of the large companies in the world, there's not really much that can go wrong. Or the biggest ones in Europe or the biggest ones in Asia, or in the long run, these things will just do well. And so 110 might maybe be a little bit too little for you. Um, the top holdings are Archer Aviation, EOS Energy Enterprises, Bloom Energy, energy companies, it seems, mostly. The type of replication, it's a physical full replication, so that's pretty good. Um, physical replication, always good. Fund volume, 19 million euro. So 19 million euros, don't get me wrong, it's a lot of money. But when it comes to a fund, like 19 million euros is not a lot. It's really not. If you think about global pools of money being used to invest, like, I mean, if we compare it to the MSCI world that we talked about before, 87 billion, right? Now 19 million, not so much. And it says here, even there's the scale. It's in the red. It's not a lot. The thing isn't super old. The distribution policy is accumulating, so that's good. Like dividends reinvested. But overall, it's not been good, listed one. It's not been very convincing. I wouldn't put any money into this if it was me. So, this is to give you some examples. And we can look at other ones. We can look at China large cap. Let's have a look at this one. I can already see here, this is not going to be good. 28 million fund size, 51 holdings, not a lot. Physical replication, high fee tier. Growth has been 14% over since 2021, it's a little bit, but it's not super convincing. It's since September 2021. So, yeah. This is to do nothing, with yeah, like with like the companies that are invested, but it hasn't been a strong growth. So, you can filter, for example, here through to go into the highest growth, in the past year. And you can even add, say, show all select columns, and you go into, 5-year percentage growth. That's maybe a good indicator. And you look at this, okay, this is like Bitcoin, Ripple, all of these things, quite risky. So maybe not the best, but if we look here, if we want to look at safe investment options, Euro stocks, banks, these are some strong ones that have been performing quite well over the past 5 years. Invesco European bank sector, the banks have been doing pretty good. Euro stocks 600, they're pretty good. So these are all thematic ones. But, this is just to show you, like, these have been really good. There's specific sectors that have been doing really well, like S&P, US Energy Select. Or if we go into the Euro stocks banks one, So there's these ones that I guess have been doing really well. Quite large fund sizes, 49 holdings, though, not so many holdings. So, this is to show that you can invest and, do your research and that way. But I mean, yeah, be careful because, this one might seem, oh, wow, past 5 years, insane. 300% growth. European banks must be going crazy. Like they must be so amazing and like safe investment, right? But if you look here, like, I mean, since 2008 until 2023, these things have not been growing at all. So I mean, in this ETF, right? I'm not shitting on European banks. I'm just saying this ETF hasn't been growing in the past 5 years. So, do your research. In this course, we're going for passive investing. There's all these ETFs you can buy. There's so many options. It can be really overwhelming, and it really shouldn't be. It really shouldn't scare you. There's options out there. It's good to consider them. But in this course, we're going to show you exactly what kind of portfolio you can build that's super safe and passive. We're just going to buy a few ETFs, like 3 or 4, and they're going to cover hundreds of companies, and you're going to be fine. You don't have to go crazy about all these options because we're going to show you exactly which ones could be good for you if you're in early stage, or in any stage, to consider these three ETFs, to put, say, 100 euros a month, 200 euros a month, whatever, depending on your account management, that we've discussed before, about 20% or up to 50% of your money that you can put into investments. And you can easily invest into some ETFs that cover the globe, that are safe, and it will be good for you in the long run. So it's really nothing to worry about. This is just to show you what you can do and how you can research these things. So, nothing to be scared about. It's easy. Check the ETF checklist and go through it. We're going to show you in any case how to build a portfolio that's strong, that's got global coverage, that considers Europe, Asia, the United States, and make sure that you cover those global markets that are doing really well, that are emerging, and have a strong trajectory over the next 20, 30, 40 years. Obviously, keep educating yourself further. The most important investment you can do is into your own education. So keep learning in the space, but investing is easy. It doesn't have to be difficult. So use trusted sources. As key takeaways, save yourself time by looking at the historic performance first. If the fund does not perform well, there's no need to keep researching. Look at the ETF checklist, look at these things that we talked about, and yeah, take it easy. Honestly, don't go crazy. There's a lot of options, but I honestly try to, when it comes to passive investing, look at these big established ETFs that have hundreds or even thousands of companies, because when you look into these sector-specific ones, you kind of move away from passive investing. It's almost like you're already trying to predict the future and say, okay, wow, I'm going to cut some corners here because I'm going to invest into the big tech stocks because I know tech is huge and we're in an AI revolution and blah, 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 blah. These things are going to go through the roof. But you're trying to predict the market. And what we're trying to do with passive investing is to go with the market. We're not trying to battle the market. We're going to try to, catch the wave and go with it rather than trying to outmaneuver the way, stock prices are going. So it's really easy to just go with the biggest, most established ones.